So what do the government's new tax changes mean for you as a property investor? I'm Nicol from Opes Partners, where we help you become a successful property investor. And today, I'm going to cover exactly how these changes will impact you. If you had a rental property, a standard rental property, and you'd borrowed money to invest, like most property investors, you might make a positive income of about $45,000 over 15 years. Now, with the new changes, that could mean that you actually lose $30,000 over the 15 years' time. So it means that you're topping up your rental property more than you were previously. So what were the changes that the government announced? Firstly, they made changes to the bright line test, which is a capital gains tax by another name. They've changed the way that interest payments are calculated from a tax return. They've introduced help for first home buyers, and they've announced an infrastructure support package. Now, the first two are really important to you as an existing property investor. Previously, we've had a bright line test of 5 years, which means if you buy and sell a property that's not your own home within 5 years, you pay tax on the profit. Now, this has been extended to a 10-year period. So that means if you buy an investment property today and you sell it in 7 years, you're subject to bright line test, kind of like a capital gains tax. Now, there are two exemptions around the bright line test. The first is new builds. If you buy a new property, something direct off a developer, that's only subject to the 5-year bright line test, the same as it was previously. The other exception is your own home, and you can only have one home. So if you've got a batch, that is still subject to the bright line test, and 10 years if you buy today. So how is the tax calculated? So if you make a net profit of $100,000 on an investment property that's subject to the bright line test, and by net gain, what I mean is your profit after cost. So if you've got real estate costs, that comes off your actual net profit. So $100,000, and if you're on the tax rate of 33%, then that means you're going to pay $33,000 to the IRD in tax. How do I avoid paying this? And this is going to be the question on everyone's lips. You either hold the property for more than 10 years, or you buy a brand new property and you're only subject to the 5-year. So the bright line test absolutely has some impact, but very little really. So let's talk about the interest tax deductibility, because this is the big one. This is the thing that's going to affect most property investors out there and going to have the most impact on the market. Let's take an example of how tax worked prior to these changes. If you had rental income of $25,000 a year and you had operational costs of $10,000 a year, rates, insurance, maintenance, accounting, and your interest that you paid the bank was $12,500, that means your net profit is $2.5K a year. Now, based on a 33% tax rate, that's $825 worth of tax that you've got to pay. So what's left over is $32 a week. So that property is positively yielding $32 a week. So that's great. Right, so this is the big change. Now we've got rent of $25,000 a year still coming in. Your operational costs are the only thing that you can claim back in your tax return. So that's $10,000 still. So from the IRD's perspective, your profit is now $15,000. So at the 33-cent tax bracket, that's $5K worth of tax that you've got to pay. Now, I know you're not making that, but that's still what you've got to pay to the IRD, and this is the big impact. What that means is all of a sudden you're paying an extra $4,000 in tax. Your interest costs are still $12,500, which means your take home after tax is negative $47 a week. So it's a big difference. So how do I avoid paying up? At this stage, we expect that new builds are going to be exempt, and the law is yet to be written. So one of the big things is the definition of new and what is actually going to be considered as a new property. So Ed and I are going to be very active in encouraging the government to consider a broad definition of new, but there's going to be more to come on this later. So when does this all take effect? So if you buy an existing property, an existing home, and turn that into a rental property, then that interest deductibility is gone from the 1st of October this year. So it has a major impact almost straight away. If you already own a rental property, then that interest deductibility is going to be phased out over 4 years from the 1st of October. So it has a lesser impact, and it means that it's going to soften that effect. And so it's not going to mean as much tax that you're going to have to pay straight away, but it is happening. Now, the bottom line is, this interest deductibility is the biggest change, and it's going to mean that you're going to end up paying more tax on income that actually is going to interest payments. So it really is going to affect the cash flow of a rental properties. For a 500K property, you're going to be about $80 a week worse off if you're borrowing 100%. The message from us is that rents will rise because economics will take over, and we expect about a 25% rent increase over the next 3 years. Now, that might sound like a high number, but just remember historic rental increases are about 4.5% to 5% per year anyway, if you look at a longer term view. So what do the government changes mean for you? Well, number one, it's going to mean you need to really consider the properties you buy as an investment property. I don't think there's as much merit in buying an existing house as a rental property anymore because the cash flows just don't work. If you're an existing property investor, it means you need to review your portfolio and make sure you're getting as much cash as possible coming in so it can help cover the tax payments that you're going to need to pay. It's also going to mean that property investors are going to hold properties for longer because you want to avoid paying that bright line tax.